I'm joined by Edward Friedman. Edward leads our Canadian equity strategy. Welcome, Edward. And we're going to be talking about one of our favorite topics today, Canadian banks. And before we kind of get into the Canadian banks, I just want to talk at a high level a little bit about we're in a recession, or hopefully coming out of a recession. But, you know, Edward, what makes this recession different than the one that we were in 2008 and 2009?
Thank you, Kevin. So there are very big differences between the two recessions, and the main differences are presented in the table on the screen. You can see that GDP decline this year is substantially sharper than in 2009. But the biggest difference is how much support the government is providing to the economy. From a retail perspective, the most significant assistance is, of course, the Canada Emergency Response Benefit, or CERB, of $2,000 a month, and loan deferrals, primarily mortgages. While business subsidies also provides income support for individuals, since many companies did not lay off as many people as they would have without that assistance.
Right, perfect. And I guess the key story going forward will be, you know, as the governments kind of wean off these programs, how the economy responds, and we'll talk about that in a bit. Now, I know getting into the weeds a little bit on the banking sector, one of the things you look at quite closely is provisions and the bank provisioning rate. And provisions is basically how much money are the banks putting aside for possible future loan losses. And so can you talk to that as we've kind of watched the bank's results the last couple of quarters?
Yes, so due to the coronavirus crisis, provisions increased sharply in the last couple of quarters. However, in the latest quarter, besides Scotiabank, all the banks cut their provisions. And all of them guided that these provisions will continue declining in future quarters, even though they will still remain higher than last year. And the reason why they did this is because they built large reserves against loan losses, and they believe that they will be sufficient to cover any future actual loan losses that will come their way. Now, it is important to note that actual loan losses and provisions and reserves are not the same thing. And you can see on the chart in 2009, the blue bars, that actual losses at the time were lower than the reserves at that time. And the reserves that banks have this year are larger and much larger than the actual losses in 2009. Which raises obviously the question, will losses this time be larger than those in 2009? The answer to this question depends on the trajectory of the government programs that I just mentioned and whether they will end or not. And it is important to note that the only thing ending is loan deferrals. All the other programs are continuing. Wage subsidies has been extended until the middle of next year. And even though CERB is officially over, its replacement, the CRB, or Canada Recovery Benefit, will continue to provide ample support to individuals with easier qualification criteria. Also, in the latest release, the bank stated that 99% of the loans that came off deferral are current.
Right.
And even some customers continued paying the loans while they were on deferral.
Right.
So to answer the question whether loan losses will be larger or smaller this year, it is difficult to answer this question. However, we believe that because of the substantial government support that will continue well into the next year, the chances are that loan losses this time will not exceed those of 2009.
So, Edward, one of the major reasons investors own Canadian banks is for the dividends and the dividend income. And I can remember even you and I were talking about this back in March and April at the height of the kind of financial stress of the pandemic, that there was talk of, you know, bank dividends maybe being cut. And so now that we've had a quarter or two of bank earnings, what's the dividend outlook look like for the Canadian banks?
Kevin, this is a very pertinent question these days because, as you mentioned, the capital ratios declined in the last couple of quarters, and this definitely increased the risk that the dividends may be cut. However, in the latest release, capital ratios started increasing as provisions started declining. And you can see on the slide that all the banks currently have substantially more capital above the minimum regulatory capital level of 9%. And in this chart, which gives us the most confidence that dividends are unlikely to be cut, you can see that all the banks have ample excess capital, way more than their actual dividend payments.
Right.
So we believe that with all the government support to individuals and businesses, and with capital ratios above or close to 12%, we believe that dividends are safe and are unlikely to be cut in the foreseeable future.
Okay, excellent. And I think you and I were also talking about the Canadian banks earlier, and the regulator of the Canadian banking industry, a group called OSFI, has, for now, said that the Canadian banks cannot increase their dividends, correct?
Kevin, this is correct. What they did is that they relaxed their capital ratios, or they relaxed their capital rules due to the crisis. The trade-off was that no dividend growth, no share buybacks while these relaxed capital rules are in place.
Okay, thanks, Edward. That's a really good deep dive into the Canadian banks. However, more importantly, what does this mean for our clients and how are we positioning our Canadian equity portfolio?
So the banks underperformed the TSX in 2019 and so far again this year. Valuations reached levels last seen at the height of the financial crisis in 2009, which basically means that investors are expecting the banks will see their earnings cut by more than 50% permanently.
Wow.
In such a scenario, all that is required is just a whiff of some positive news and the banks can generate substantial outperformance. For example, a year after the banks reached the bottom in 2009, the banking index increased by more than 90%, outperforming the TSX by almost 40%.
Right. Wow.
Obviously, we do not know how the banks will perform after we exit this recession, but we believe that all the ingredients for a sharp rally in the banking sector are there, which is why we have a substantial overweight in this sector.
Okay, super. So what I'm hearing is good value, the dividends are safe, and we're going to maintain our current exposure to the banking sector and maybe even increase it a tad on dips when we have the opportunity.
Yes.
Okay, thanks very much, Edward.